If you are a dividend investor, you have heard all the arguments. Dividends are not free money. They come out of the stock price. Paying dividends means the company has no more good growth ideas. You do not need dividends, just sell shares when you need cash. And over the long term, growth stocks are always going to outperform dividend payers anyway. Here is the thing, there is a kernel of truth buried in each one of those arguments, and we are going to go through every single one honestly. Because understanding what is true and what is misleading is the only way to make good decisions with your own money. But here is what people who make those arguments consistently miss. Investing is bigger than simple math. And by the end of this video, I think you will see exactly what I mean. Let us start with the most common one. Dividends are not free money. They come out of the stock price. This one is technically correct. Here is how it actually works. Say a stock is trading at $100. The company announces earnings of $5 per share in excess cash. They plan to keep $1 in retained earnings for future business investment and distribute the remaining $4 per share as a dividend to shareholders who own the stock by a specific date, called the record date, and distribute the remaining $4 per share as a dividend to shareholders who own the stock by a specific date, called the record date. Because stock transactions take 2 to 3 days to settle, the ex-dividend date is usually 2 days before the record date. Before the ex-dividend date, the stock should trade at roughly $105, reflecting $100 in future earnings value, $1 in new retained earnings, and the $4 dividend that is coming to shareholders. On the ex-dividend date, the stock should drop by approximately the dividend amount, back to around $101. So yes, the dividend comes out of the stock price. It is absolutely not free money. It is the earnings a company generated, distributed back. But here is what that argument completely misses. The real difference is not the math, it is who controls the allocation decision. When a company pays you a dividend, you get to decide what to do with your share of the profits. You can use it as income. You can reinvest it in the same stock. You can reinvest it in a completely different opportunity. That flexibility is yours. When a company retains the earnings instead, you still have a claim on those profits, but you are trusting the management team. Neither approach is automatically better. They are just different choices about who makes the decision with your slice of the profits. The second argument is that if a company is paying dividends, it must have run out of good ideas for growth. There is a version of this that is fair. If a company with genuine high-return reinvestment opportunities chooses to pay dividends instead of deploying that capital at high rates of return, shareholders are worse off. That is a real trade-off worth understanding. Deploying that capital at high rates of return, shareholders are worse off. That is a real trade-off worth understanding. But the argument falls apart when you apply it broadly, because a company that consistently pays and grows its dividend is demonstrating stability. Look at the 5-year total return comparison between Google, Amazon, Berkshire Hathaway, McDonald's, and Starbucks. Google leads with around 115%. But the next two best performers over that same 5-year period are McDonald's and Starbucks, both dividend payers, both outperforming Berkshire Hathaway and Amazon over that stretch. Just because a company retains all its earnings does not mean the stock price is going to reflect that. Consistency sometimes wins. The extreme example here is Peloton. Investors who bought at $125 in 2021 saw it below $5 less than 2 years later, a growth story that never fully materialized and never turned a profit. Before we go further, real question. In your own portfolio right now, are you mostly invested in dividend stocks, growth stocks, or are you mixing both? Drop your answer below. I reply to every single comment, and I want to know exactly how this audience is positioned. The third argument is that dividends are unnecessary because you can just sell shares whenever you need cash. This one is technically true. If you have strong total returns, selling shares whenever you need income is a perfectly valid approach. But here is what that argument glosses over. Selling shares makes you entirely dependent on market timing and current stock prices at exactly the moment you need the money. If the market is down 30% when you need to generate income, you are either selling more shares than you planned, accepting a lower dollar amount than expected, or delaying your need, none of which are great options. Dividend income is different. You can plan your cash flows with a reasonable degree of certainty, regardless of what the stock price is doing. That predictability has real value, not just financially, but psychologically. Knowing what your income is going to be allows you to make decisions about your financial life without being hostage to whatever the market happens to be doing in any given month. Think of it like a business ownership mindset. When you own shares in McDonald's or Valero, you are a partial owner. They pay you a portion of the profits every quarter, not because you sold something, but because you own something. Selling shares for income is not wrong. But it does add variability and timing dependency to your process that dividend income simply does not have. The fourth argument is the broadest one. Over the long term, growth stocks always outperform dividend stocks. Comparing three Vanguard funds over roughly 25 years, the Vanguard Growth Index Fund, the Vanguard Dividend Appreciation ETF, and the Vanguard High Dividend Yield ETF, the results are clear. The Growth Fund delivered a compound annual return of around 11.37%. The Dividend Appreciation Fund delivered around 9.07%. The High Dividend Yield Fund delivered around 7.77%. So the Growth Fund won, and that is worth acknowledging honestly rather than pretending otherwise. But here is the important context. That 25-year period included multiple extended stretches of near-zero interest rates. When money is essentially free to borrow, growth companies with high future earnings potential get valued very aggressively. That macro environment specifically favored growth over income. We only had roughly 4 to 5 years in that entire 25-year window where the federal funds rate was above 0.5%. That is an unusual environment, and it benefited growth stocks disproportionately. The more interesting question is not which category won historically in one specific interest rate environment. The more interesting question is which strategy you can actually execute consistently over 20 or 30 years without making emotionally driven decisions that destroy the theoretical return. A recent study found that 66% of investors have made an impulsive or emotionally charged investing decision they later regretted. For Gen Z investors, that number was 85%. Consider the Meta example. Someone who bought Meta at $166 5 years ago has an 80% total return today. But to get there, they watched the stock fall to $53 within 18 months of buying, deeply underwater on their investment, then recover to $380, then crash to $90, then recover to where it is now. The 5-year chart looks smooth in hindsight. Living through those swings in real time is a completely different experience. How many investors actually held through all of that? Dividend stocks have price swings too, but the consistent growing income stream gives investors something to hold on to psychologically. When you can see your income growing every year regardless of what the price is doing, the emotional pressure to sell at the wrong moment decreases significantly. When you can see your income growing every year regardless of what the price is doing, the emotional pressure to sell at the wrong moment decreases significantly. Here is the conclusion I have reached after thinking carefully through all 4 of these arguments. We do not have to choose. Growth and dividend investing both have genuine advantages and real disadvantages. Growth generally outperforms over long periods given a favorable macro environment, but it comes with wild price swings that make consistent long-term holding genuinely difficult for most investors. Dividend investing offers predictable and growing income, lower emotional pressure, and strong downside resilience, but it is unlikely to maximize your theoretical total return ceiling. The approach I think makes the most sense for most investors is a combination. If you have a long time horizon, 25 or 30 years, getting meaningful exposure to growth is valuable. The approach I think makes the most sense for most investors is a combination. If you have a long time horizon, 25 or 30 years, getting meaningful exposure to growth is valuable. A low-cost growth index fund in a retirement account where you contribute consistently and leave it alone handles that side of the equation well. The distance of a retirement timeline reduces the emotional impact of price swings because you are not watching it trying to decide whether to act. Building a portfolio of dividend payers alongside that serves a different purpose. It creates real cash flow and keeps you focused long-term. The goal of investing is not just the highest number on a spreadsheet. The goal is to reach financial independence and genuine freedom. Dividend investing done well is not the fastest path to that goal, but it is one of the most reliable paths. And reliability, the ability to stay consistent through every market cycle without making the decisions that derail most investors, is worth more over a lifetime than most people realize. Financial independence is real freedom. Keep building, keep stacking wins, and trust the system. Do you think dividend investing is overrated and growth is always the smarter move? Or do you think the psychological benefits of a growing income stream are genuinely undervalued by most investors? Drop your take below. Team growth, team dividends, or team both? I reply to every single comment. Hit subscribe if you want more content like this every week. Now go build something.